investing in unit trust is not only about selecting the fund and then after that forget about it. What you need to do is that you need to select the fund and then build a portfolio, and after that you still need to maintain, and manage the portfolio for it to continue to be relevant and to be profitable. To say that you invest in unit trust is not good enough. You need to tell or you need to differentiate whether you are investing into a equity unit trust, a bond unit trust, a money market unit trust, or REIT unit trust. And all these different type of unit trust will give you exposure to different underlying asset and give you different expected return and give you also different kind of risk exposure as well. So a good investor should be knowledgeable enough to differentiate one type of unit trust to another type of unit trust so that you are able to select the right investment for you or the right unit trust for you. When we talk about rebalancing, we are talking about to sell some of the equity fund if you got and buy bond so that your portfolio can be rebalanced back to 50% equity, 50% bond fund again. The idea of this is to maintain the portfolio according to your risk profile. Otherwise, your risk profile, your risk exposure would have increased significantly. Okay, and the second benefit is that what you have done by doing rebalancing is that you have just sold those investments that have increased in price, okay, and buy investments have dropped in price. So this is the application of buy low, sell high strategy. This is where I mean, how do you find extra profit when you invest into unit trust? So of course, the idea is that you want to make sure that you always can maintain the portfolio with the best of breed fund, because whatever fund that you buy may be a best of breed, may be performing fund, but it may not be a performing fund forever. After 2 years, maybe the fund manager left, maybe there is a better fund manager in the same category, so that's where they need to do the changes. When you invest in unit trust, whether they are declaring dividend or whether they are giving you capital gain, these are all the money coming from your own pocket. So it doesn't matter, because a particular unit trust fund that may have got a capital gain, it will be reflected on the price to show that the unit trust price grow from 1 ringgit to become 1 ringgit and 10, 1 ringgit and 20. Okay, for the same fund that have got capital gain, the fund manager may choose to distribute the dividend to say that instead of like keeping the price at 1 ringgit 20 cents, they may do a distribution exercise to say that I want to give the 20 cents back to unit trust investor. So that's where the price may after distribution of 20 cents may go back to 1 ringgit. So that goes to show that whether a unit trust fund they will grow in capital growth, or whether they distribute dividend to you, at the end of the day, you're not missing anything, or you're not getting extra or anything, because these are all the money that you originally have. Okay, so I would say when we invest, unless you are a retiree that you really want to plan your retirement income in such a way that you can receive a regular distribution of dividends from the unit trust. Otherwise, for most people who are planning for long term, we should focus into the capital growth potential of the unit trust fund, so that it will help us to fund whatever financial goal that we have got.